Okay, as I mentioned, I do want to talk about a trade in the close yesterday. A small trade. There was a three-legged box, and the fills that I received, I'll get into the details. The first thing I did, and this was about two, just under 3 minutes after the market on close imbalance came out. It usually comes out with 10 minutes to go to the close. I bought a 74.45 put, and then roughly almost a minute and a half later, I boxed it off. And this is a three-legged box because we have this 45 strike line. I have one put that I'm long. On the 40 strike line, I'm long a call. And on the 45 strike line, I'm also, well, for the calls, I'm short a call. But at the 45 line, note that I'm short one call and I'm long one put. And again, down at the 40, I'm long a call. So this is you can think of it as a three-legged box. There's one leg, long the 40, short the 45. It's leg number 2. And along the 45 put, it's leg number 3. They're not necessarily numbered in that order. It's just the way I mentioned it. Okay, so and another thing which I will discuss is that sometimes if you get enough of a move, you can do a two-legged box. So in that case, and I'll get into it, you can, well, I'll get into it in a couple minutes. All right, so the way this looks on paper is, here are the fills that I have for this. So the first thing I did was I bought the 45 put, and I'm going to open this up in a new tab and one more just in case. It'll be easier to navigate and run through the trade, the components of the trade. All right, so the first thing I did was I bought the 45 call put, pardon me. I bought the 45 put for $1.50 with about 7.5 minutes to go to the close. Let's see. Yeah, about 7 minutes to go. 7 minutes and 17 seconds to go for the close. Bought the 45 put. What do we have here? This does not look right. Oh, let me zoom in. 74.45. No, it's fine. Okay, so the most I can lose on this trade is the cost of entry, which 1.5 is the multiplicand and 100 is the multiplier. So $150 if I did nothing. And the market expired at 45, 74.45 or higher. So greater than or equal to 74.45, I lose my buy-in to this little game, and that's $150. Anything below 74.45, I start making $100 per point, and the risk profile looks like this. Okay, very simple. Now remember, with box, I didn't just leave this as a single standing trade. I decided to purchase a call spread. And what I did there is I went to the 40 strike line and I bought that call, and looks like I paid $3 for it. And then I sold the call one strike line higher at the 45 strike line for 85 cents. So this call spread cost me $2.15. 3 that I paid, and I subtract the 85 that I brought in as a credit for the sale of the 45 line. Now note that my total expenditure, and this is a three-legged box, here's one leg, here's another leg, here's the third leg. My total expenditure is $365. It's 3.65 times the multiplier of 100, 365. So further note that now that I have this boxed off between 40 and 45, this box has to go out at $5. If you quickly think about why, let's say that the market closed at 74.40. All right, the call spread goes to dust. That's worthless. The put is worth $500. So 500 minus my cost of 365 would leave me a profit of $135. If we look at it the other way, let's say that the market closed at 74.45. Now this call that I bought, or the put that I bought for $1.50, goes to dust. It's worthless. However, the call spread is worth $500. Again, 500 minus my cost of entry, 365, is $135. All right, and anything in between, then each of the call spread will have some value and the put will have some value. So at a price of 74.41, the call spread's worth 100. The put spread would be worth 400. So box goes out at $500. At 42, the call spread's worth $2. The box is worth, the put is worth $3. So the box in total is worth $5. Now think about quickly, let's quickly look over prices above 74.45. Well, this sale here prevents any further gain on the put spread. Okay, so the max at this call spread. So the max that the call spread will have in value is $500 minus the cost. And to the lower end, though, it's different because this 74.45 put is not constrained or limited by any other portion of the trade. So this standalone guy will reap to benefit dollar for dollar with every price decrease in the cash. So if it goes down, let's say it would have closed at 74.35. Well, this put would then be worth $1,000 because it would have $10 from the strike line, 74.45 to 35, and 10 times the multiplier of 100 is 1,000. If it goes down to 25, this put will be worth $2,000. So they usually, obviously, at the end of the day, it's not likely to have such a big move. However, I have seen moves of greater than 15 handles away from the area of the box. Doesn't happen often, but occasionally something does cause a large move relative to what's left, time of the day, and the expected move that corresponds with however much time is left. In this case, minutes. And again, since the box has to go out at $5, I now have guaranteed worst case scenario of a profit of $135 minus, of course, your commissions and exchange fees. And I have, in theory, unlimited profit to the downside all the way to zero. So, well, I guess that would limit the profit, but I'm basically good to go for any move to the downside with this type of structure. Now, another thing that can be done, and think about this. Well, let's say that prices are trading in such a manner that the market is moving down after you put on the trade. You have this put. So let's start with the put. We have 74.45 put that we bought for $1.50, and the market moves low enough. Let's say it's trading somewhere around 40, and then it starts to descend a bit more. So rather than buying the call spread, what you might be able to do is buy the 74.40 call. So note that if prices dropped enough so that the 74.40 call is trading for $1.30-ish, okay, let's see what happens there. So rather than doing a call spread, we're going to do a call. And let's say you were able to buy the 74.40 call for $1.30. Now your total cost for this is $280, 2.8 times the multiplier of 100, 280. You know you're going to make $220, worst case scenario, on this box. It's a two-legged box now. because your cost is $2.80 and it has to go out at $5. And now look at what you have. You have a synthetic strangle. This two-legged box is really a synthetic strangle. You're long the strangle, you're long volatility in the last few minutes of the day. But what's cool about this is that any price below your synthetically long put and your synthetically long call from 45, note the strike lines. We have the put at 45 and the call at 40. But because this is a two-legged box, you're really synthetically long the 74.40 put, because inside the box, each component of the trade neutralizes the other. So there's no gain or loss between the 40 and 45 strike line, but there's a guaranteed profit of $220. But the 74.45 put is now really, you're long a synthetic 74.40, not the 74.45. And on the call side, since the 74.40 call is neutralized between 40 and 45, you're synthetically long the 74.45 call rather than the 74.40 call. And on this call, you do have unlimited upside potential because prices can go to infinity, where the put is bounded by zero. But if this put ever traded anywhere near zero, you probably wouldn't have to worry about anything because it'd be the end of the world somehow. All right, that being said, again, rather than having a three-legged box, where you're synthetically long the 74.40 put here, even though the one you actually bought is 74.45, you have a two-legged box. And again, another way to look at it is the 40 strike line call that you bought, you're really synthetically long the 45. And the 45 put that you bought, you're really synthetically long the 74.40 put. If you can buy it for, you're long synthetically, regardless of what you paid. But what you pay, the difference between what you paid and $5 is your guaranteed profit. So let's say that you paid 3.5 for the call. All right, you're not going to make any money. You're going to spend commissions and fees, and you're going to be at the zero line because the put and the call, the cost of it added up to $5. So you're not making any money on the box, but you still have this position that can make decent profits should you have an accelerated price movement after you establish the position. If you buy the put, which I did, first thing you do is buy the put, and you start to have an accelerated downside move right away. Who knows? Maybe you can buy this call for $1. And one of the reasons you'd want to do that is if the 74.45 call is trading for, let's say, 10 or 20 cents, okay, because prices have dipped enough for this call to basically be worthless, why would you bother selling it? Just buy the put at just buy the call at the 74.40 strike line, and don't worry about selling the 45. There's no need in a sense for a call spread, because the 45 call you're selling is worth almost nothing. So pay for the 40 call and leave yourself with a two-legged box rather than a three-legged box. All right, so that should be it for this one. That'll wrap it up. I hope that was helpful, and thank you for tuning in. That's the two-legged box, but trade was actually the three-legged box. Hope that was helpful. Catch you guys next time.